Welcome, and thank you for joining today's Regulation Matters webinar. My name is Rani Turna, and I'm a partner in PwC's Financial Services Consulting and Deals practice and also lead our AML and Operational Risk practice. I'll be the host of today's webinar and also provide an update on our Banking Banana Skins report. Today, our first speakers are Petrina Dolby and Barb Elliott. Petrina is a managing director in PwC's Consulting and Deals practice in Toronto. She has over 25 years of international business experience. Petrina focuses on helping financial institutions implement their wealth management strategies from a technical, process, and organizational perspective. Barb is a partner in the assurance group at PwC, working in the Toronto office. During her time at PwC, Barb has been a member of the regulatory advisory practice, where she provided consulting services on regulatory matters to major banks, broker-dealers, fund managers, and public companies. She is currently a member of the asset management audit practice. Also speaking is Marco Fillion. Marco is a partner in PwC's Life Actuarial Services. Marco has more than 25 years of insurance experience in actuarial valuation, financial reporting, capital requirements, risk assessment, M&A, and product development. He is well-versed in several accounting bases, including IFRS and U.S. GAAP, and has experience working with U.S. statutory actuarial valuation. Before we begin the session, we have a few reminders. At any point during the presentation, please feel free to submit a question by typing it into the Q&A window on the lower left-hand side of your screen and then hitting the Submit button. We will attempt to answer as many questions as possible during the Q&A session at the end of the presentation. For any technical issues, please hit F5 to refresh your screen. If you still have technical issues, click on the Help button at the bottom of your screen or use the Ask a Question feature to describe your problem. Your full participation in today's webinar qualifies you to receive one Continuing Professional Development or CPD credit. Please note, in order to receive this CPD credit, you must be present for the entire webcast and also respond in real time to the very interesting live polling questions that will appear on your screen throughout. Now, I'd like to tell you a little bit more about today's presentation. Today's discussion will focus on Client Relationship Management, or CRM2. The aim of CRM is to enhance investor protection in Canada through improved relationship disclosure, conflict management, and suitability in account performance reporting. Phase 2, known as CRM2, is focused on enriching investors' understanding of the cost and performance of their investments. We will provide an overview of this regulation and its implications. Banking Banana Skins 2014, Inching Towards Recovery, a review of the results from Banking Banana Skins 2014, a unique report that provides insight in the changing risk factors facing the global banking industry. And finally, IFRS 4 Phase 2, Accounting for Insurance Contracts, Developments and Decisions from the IASB since the release of their exposure draft in June 2013. Now I'm going to hand it over to Petrina and Barb, our first speakers.
Thanks, Ronnie. This is Petrina Dolby, and if we look on slide 3 here, what we're going to do is talk initially about CRM2, the overall objectives and timeline, why it matters, what is different about this regulation from other compliance initiatives we've seen in the past, and what does that mean from an issue and implication perspective, as well as risk considerations. For this initiative, there's multiple dimensions that should formally be considered in the risk and control framework. We'll also take a few minutes to look at lessons learned from other jurisdictions. Today we'll briefly look at the RDR initiative in the UK and what some of the lessons are there. And then talk briefly about next steps and what are we seeing going on in the market as organizations are moving towards the next date of 2015. Over to Barb.
So our next slide just gives a quick overview of some of the objectives that the regulators had with respect to CRM2. I guess the overriding objective is to make fees and performance more transparent to investors. We noted in the last bullet here that this is really designed or geared towards retail investors, because although we all think the retail investors sort of understand a lot about the fees they pay and the performance, investor surveys have actually shown that they don't, and so this is supposed to help retail investors understand products more. In terms of the impact, there's obviously a big impact on dealers and advisors, less so on investment fund managers. Having said that, the investment fund managers are going to need to provide information to dealers and advisors, such as trailing commissions, so that the dealers and advisors can meet their compliance requirements. So we're going to move on to the timeline, summary of the timeline. And this will probably be familiar to most of you. The first being July 15th, 2014, so coming up very soon. And we expect at this stage that most industry participants are pretty much on track to meet those requirements. The first one being pre-trade disclosure of charges. And so, for example, those charges might include management fees, sales charges, trailing commissions, switch fees, change fees. And then report on compensation, or actually charges related to debt securities transactions. And one of the things that's already come into play, which I'm sure everyone is on top of, is trade confirmations, which are already being given to clients. The next piece is effective July 15th, 2015, and that will require new account statement requirements, cost information, and market values using a prescribed method. And so the prescribed method that will be used is money-weighted rate of return. And there's been a little bit of discussion in the markets about whether that's the right measure, but the regulators have clearly said now that that is the calculation methodology that needs to be moved. And I guess in terms of cost reporting and the other market value information, those will end up being all included in your annual reporting, which comes into place on July 15th, 2016. And just in terms of the timing of that, there's been some questions out in the market about, does that mean that our first statement becomes effective July 15th, 2016? The CSA has actually issued a FAQ document that talks about the timelines and how they could apply to different year ends. So you actually have a lot of options in terms of when you actually first create these annual statements. Some of the information that's required in performance is percentage of returns for the previous year, previous 3 years, previous 5 years, and previous 10 years. And then in terms of the charges, again, it's just an annual summary of all the charges, which hopefully you've already been disclosing to your clients in terms of pre-trade disclosure and other statements, but this will be now in a summary annual statement. So I think we'll move on to the first polling question. So we thought we'd just get a sense of where people are in respect of meeting CRM2 requirements. So we're hoping everyone's going to be ready for July 15th, 2014. Then you may be ready already for 2015. You may be ready for 2016. You may not be ready for anything. And then it's not applicable if you're an insurance company or someone else participating that this is not applicable to. We'll give a couple of minutes for the results to come through.
Barb, we've actually got a question that's come through that we can probably take while we're waiting for the responses, and it relates to what you talked about, the money-weighted rate of return. Is what is the difference between this calculation and the calculation typically used in the investment community? So CRM2 is using the dollar-weighted or money-weighted rate of return, and the investment community uses the time-weighted rate of return. So the dollar-weighted or money-weighted rate of return takes into account all clients' contributions and withdrawals, and also gives the portfolio managers credit for changes in the amount of money that the client has invested in that particular period. The time-weighted rate of return eliminates the impact of cash flows and calculates return only on value generated by the managers. And as Barb had mentioned, the regulator at this time feels that the dollar-weighted rate of return is more insightful and transparent to the investor, which relates back to the objective. There are varying views on this in the market, but then this also raises a challenge that we'll come back to as well when you're trying to compare client performance to an industry benchmark. So again, this comes back to one of the challenges of CRM2.
Okay, it looks like we've got enough results in now that we're going to show you. So it looks like we have a good chunk of people that are, I assume if people are ready for level item B and C, then that implies that they're obviously ready for July 15, 2014. So it looks like we've got about 40% of people that are ready for the future years, although a very few ready for the 2016 requirements, and some that are help, I'm not ready for anything. So hopefully this will help you at least get a background today on some of the issues you're going to be facing as you try to implement this stuff.
Thanks, Barb. I mean, if we look at slide 7, it's Barb has laid out what CRM2 is. What we wanted to just focus a bit on now is like, why does it matter? CRM2 is different from most regulatory initiatives that we've had in the past because it is specifically designed to have a direct impact on the client-advisor relationship. It's dynamic, as you see on the slide. It impacts all parties in the investment chain. So you have a dynamic regulation with client impact that involves multiple parties that could then have multiple outcomes. There's multiple process changes from account opening to client reporting that need to occur. So the typical response that institutions have had around sending advisors educational material or web links to describe the new rule and requirements will not be as effective here. There'll need to be more change management work and more customizing of processes and systems. When you look at some of the process changes, as Barb was talking about, performance measurement is going to be one of the most trickiest aspects. Not necessarily just on the calculations, but also getting the right data from the right sources in the right format. And then having those systems, processes, reporting, and responsibilities in place by the requisite deadlines will be a major challenge for institutions. And as we know in today's environment, with all the cost and efficiency studies going on, there's less and less time available to look at some of these initiatives, and there's always competition for investment dollars. So it's not only about doing the what, it's how do you manage the consistent message. And our experience is around the messaging and getting the right data. And as you look on the next slide, as we've talked about, CRM2 is impacting the overall whole client-advisor relationship. But this can be seen not just negatively, but also positively. One of the goals of CRM2, as Barb mentioned, is to ensure that clients understand their investments, but also that the firms who service them understand their clients, their needs, what they think of their institution, their risk appetite, their fears. So by getting to the heart of what the objective of this initiative is, should help institutions deliver on some of their client experience strategies, and also presents an opportunity from our perspective to drive investment into some of the more strategic initiatives that have recently been starved due to other regulatory and compliance issues. It's our belief that CRM2 will be one of the drivers for what we're calling regulatory-driven transformation. But again, the point and the last point on here is that's all great, but we can't forget about the advisors and what support they're going to need, because they're going to be they're actually at the coalface where success of the implementation of this initiative will be measured. And that's really when we look at slide 9. This will be the first time that clients will see some of these fees. Now, it's not that this information has not been available to clients; it has been, but certainly around some of the deferred fees or trailing commissions, as Barb mentioned. Sometimes they're not as overtly discussed with clients, or the clients just simply don't know to ask the question, so they'll be presented with this. So again, the advisors will need to have answers for many of these questions and feel comfortable in a more questioning environment. So it's an opportunity as well as a challenge. Advisors will have a clear opportunity to demonstrate their value to customers and put some clarity around the value of advice. That being said, clearly there will be organizational and technical challenges to overcome to deliver this information in a user-friendly manner, and a user-friendly manner for the client as well as the advisor. You're also going to be relying on information sources from your suppliers that can integrate with your information. So again, the number of interfaces drive the complexity of this initiative, which leads to some key issues.
So Barb again here, and I'm going to talk about a couple of the issues. But I do want to highlight here that if you haven't seen it already, the CSA actually issued an FAQ document, and it's Notice 31-337. And most of these questions are actually covered in that FAQ document, among a lot of others. And it's a very good document. If you have questions on CRM, it's likely that your question will be there. So I'd recommend, if you haven't seen that, that you refer to that. The first point here about potential duplication, I mean, because there's different players in the industry in terms of advisors, investment fund managers, brokers, et cetera, there's been a bit of question about who's responsible for disclosure. And so it's really the person who has the kind of KYC would generally be the person that's responsible for disclosure. If you have something like a referral arrangement where someone's referred a client to a portfolio manager or an advisor, then the referral person would not be responsible, assuming they don't have the account, but the advisor would be responsible for their disclosures. And I think that issue is covered in the FAQs. The next point is around trailer fees, and Petrina touched on this in terms of some of the complexity of the calculations here. Is the different parties may be calculating this in different ways. And so you need to be sure that all your dealers, your call centers, anyone that's going to be touching the clients actually understands how those trailer fees are calculated, because we expect that there's going to be questions from clients on that issue. And that also leads into the customer complaints issue. We expect that, or a lot of industry participants expect that there'll be more complaints once this information comes out to investors. One of the other issues is book cost versus original cost. I'm not going to go into the definition of each, but I do just want to highlight that you're allowed to use either. In terms of transfers of accounts, one of the questions that's arisen is, if a client transfers out partway through the year, do you still have to do an annual statement for them? And the answer, again covered in this FAQ document, is no. Once the client's closed your account, you don't have a requirement any longer to do an annual report. Having said that, if you want to do one, you can. And then I guess the last point I think I've already touched on in terms of how to consistently manage the message and making sure that all people across your organization have the same understanding of things like fees, performance, how they're calculated, etc. So moving on to slide 11. Petrina really touched on this. The only thing I wanted to highlight on this slide was the last point really is you can see this as just a regulatory initiative, or you can see it as a broader initiative that maybe you can use to help improve your relationship with your clients, etc. And so one of the things a lot of people are going to do is try to integrating this with what their communications on value of advice. So making sure that you're really clear when you're giving these investors their statements on costs is what the value is that they're getting with that. So I'm going to hand it back to Petrina.
So yeah, and the other challenge around dealing with this, yes, you can look at it as a transformation, but the challenge, as we all know, is finding the right resources to deal with that. If we look at slide 12, what we've been finding in the industry as we're working with our clients is once you've just laid out your high-level requirements for CRM2 and you've laid out the process design and technology solution, you're looking at how effective are we going to be for implementation. And again, a framework that we've been discussing takes a number of dimensions into account when understanding the needs that need to be considered. Again, because it's complex, it's not just about, and this is an example of one of the frameworks, it's not just about the regulatory compliance that you see in the top right-hand corner where there's some questions around, does your solution comply with the CRM2 requirements? Are the requirements accurately, as Barb mentioned, understood across all stakeholders? Has other work from other initiatives been leveraged and integrated? But also you need to look at it from an operational perspective. So do you have the right operational procedures? Do you have the right controls framework in place? Do the high-level business requirements, have they been defined and linked into the operational roadmap? From a client satisfaction, or here we talk about what is the potential for client dissatisfaction from a risk perspective. Does the solution have a potential negative impact? Is there a potential reputational risk? How have you reviewed communications for consistent messaging? Are there client interactions with third parties to be aware of? And that's clearly, that last point is an area where there's a lot of concern with a number of our clients right now, especially when you start considering the growth of digital and social media, et cetera. So as you go through this process with a view of a risk, this starts putting a more methodical process in place that you can compare and start testing your readiness. And if you look on slide 13, again, here's an illustrative example of some of the considerations our clients are considering as they go along their CRM journey. So you have the risk framework, but then what do you do with it? So we've looked at risk criteria ratings from a low, moderate, and high, and some definitions around whether the solution is compliant, where there's manual versus automated, where there's interfaces, and some of the risk drivers that we believe are most important are around client visibility. So high client visibility, which a number of these aspects have, will increase risk rating and vice versa. Complexity of the solution, so if your solution requires more advisor front office and or third-party involvement, that would increase your risk rating, and you would need to doubly ensure that everything was covered, as well as your CRM solution maturity. So a CRM solution that has not been fully developed or relies on a number of manual processes or systems to be integrated, or external systems, would also potentially raise your risk level. The outcome of this assessment would help modify your CRM2 roadmap and where your focus needs to be on the next 12 months towards 2015 and then towards 2016, and drive as well your roles and responsibilities charting, or as the tool we use as a RACI as you move forward. So again, as I mentioned at the beginning, we would take a brief look and see what we can learn from elsewhere. So I'd like to hand back over to Barb.
So we've highlighted here what's happened in the UK, and again, many of you may be aware of this, but in the UK, the FSA basically banned commission-based systems of advisor remuneration. And actually, this has been similar in other countries such as Australia and India, and the lessons learned are all similar. But we've highlighted the UK here because it's probably gotten the most press. But I guess the main message I want to take out of here is that generally, the RDR experience has resulted in advisor capacity having shrunk, a lot of advisors leaving the market, margins shrinking, and therefore the advisors in the market actually targeting more affluent customers and less advice actually being given to retail investors. We're not saying that this ban of commission is going to happen in Canada. There's nothing out there here yet to say that that's going to happen. But a lot of experience in other countries has shown that when you give a lot more information about commission or ban commissions, you can basically have a negative impact on the ability to provide advice to clients. So we're hoping that's not going to happen in Canada, but I suppose it's possible.
And how some of the institutions have reacted, specifically in the UK, is looking more towards a self-service or guided self-service. And then that leads to other considerations about fiduciary responsibility.
I think that's probably it on that. And we'll move on to some implementation issues. Again, in that CSA FAQ I mentioned, the regulators actually have recommended some of the things that you need to do, and they're listed on this slide. But what I would recommend that you kind of do now, if you haven't done already, is essentially do what we call a gap analysis. So what are you doing now? What do you need to do? Who needs to be trained? What do you have to do in your compliance? What policies and procedures do you have to update? What reporting do you have to update? And then basically identify what's the gap. And essentially, based on that gap, you can then do your work plan on CRM2 and implementation. And we actually do have a few service providers on the line, and it's possible that sometimes you'll need the help of your service providers if you're using outside service organizations to do certain functions for you.
So, and that's really similar to what the points on 17, like what should you be doing, and what have we seen clients doing. So our assumption is to a large extent, the high level requirements are done. If not, they need to be done, and design and map your solution to those high level requirements. Have a project team in place. If not, look how you can have a team looking at that and ensure the team's thinking holistically. As we've talked throughout this, thinking about the overall client relationship versus just regulatory compliance. As Barb said, you've looked at the gap analysis and use all the output from that to design your transformation roadmap. Get the advisors involved, in terms of mobilization, training, communication, and client communications is going to be key. Understand around the cost effectiveness of your approach, and from a stakeholder assessment, ensure that the stakeholders are all aligned around where are your priorities around cost, service, client experience, because you could spend a lot of money on this initiative, but you need to be clear up front as to what are the expected outcomes. Understand how you're going to collaborate with suppliers early, and understand the impact of your external disclosures. Again, cannot understate the importance of data. Do you have the data that you require internally? Can you communicate that data that you need externally from suppliers and industry utilities? Are your systems flexible enough to meet these demands? Can they support the required performance management KPIs that are needing to be developed, and what are workflow implications? understanding how the client statements are going to be impacted. And, some of these thoughts continue over onto slide 18 around, once you've done all of that, as you're getting ready for go live or readiness assessment to identify any additional risks or gaps I talked about earlier. Are there additional service providers? And then really the ongoing stakeholder alignment and change management. This goes back to some of the basics of overall transformation and change management programs. Why do they fail? It's like, key stakeholders aren't involved and aligned. And I think especially for this, as it's impacting the whole value chain and is really going to be in the forefront of the client, it's of utmost importance.
Okay, great. Thanks, Petrina. It's Rani. I'm going to spend the next 10 minutes or so talking to you about Banking Banana Skins 2014 from both a Canadian and global perspective. Banking Banana Skins is a very unique report and provides insight into the changing risk factors facing the global banking industry, as seen by a wide range of bankers, banking regulators, and close observers of the banking scene around the world. It's produced by the Center for the Study of Financial Innovation, CSFI, in association with PwC. It also includes insights from over 650 responses from 59 countries. We had great participation from Canada this year, which is just fantastic. There were 45 respondents, 28 bankers, 11 observers, and 6 risk managers. We've explored the Canadian responses and studied them against the global averages. Interestingly, Canadian banking executives felt the most prepared to deal with these risks compared to their global counterparts, a testament to the relative strength of the Canadian banks. On this page, we've compared the top 10 risks for Canada against the globe and the relative rankings in the prior year. What's interesting to note is that in Canada, interest rates made the top 10, whereas it did not when compared against the rest of the globe. Shadow banking also made the top 10 in Canada this year, whereas it does not appear to be a top risk for the rest of the globe. It's always interesting to note the movement in rankings year over year. Our report revealed that criminality, interest rates, shadow banking, and social media were big movers up this year. Where we saw some downward movement was in management incentives, corporate governance, and profitability and capital availability. I thought it was interesting to note that corporate governance did not make it to the top 10 in Canada, whereas it is still on the list from a global perspective. Given all the work and focus that many financial institutions have had on corporate governance initiatives over the past year or so, subsequent to the issuance of the OSFI Corporate Governance Guideline in January of 2013, it is great to see that this area is not viewed as a top 10 risk and that respondents felt comfortable that the work they've been carrying out is certainly starting to make a difference in this space. So what did we see this year? Regulation has been ranked the 2014 primary risk in both the world and in Canada. It's not surprising at all, given that we're 4 to 5 years into what is likely a 10-year regulatory journey. Many respondents felt regulatory change had gone too far. One Canadian bank director referred to it as a gotcha attitude against banks. The longer-term impact of these regulatory changes is certainly yet to be seen. Some feel that the changes favor larger banks that can better absorb these significant costs. Increased regulations for banks that increase the risk of non-banking entities providing similar services while sidestepping the regulatory matrix. That's why shadow banking also emerged this year within Canadian banking executives' top 10 risk factors. Criminality and technology risk also ranked very, very high, especially in comparison to world rankings. These results are not to say that Canadians are more prone to criminality as a risk to the financial industry, but that there's a high level of awareness and overall increased sensitivity to cybersecurity. I'm not going to spend too much time on this slide other than to note that in terms of the top 10 risks from a global point of view, they are really at a different level in terms of ranking compared to the rest. You'll note that the averages for the top 3 are much higher than the others. The survey asked respondents how well prepared they felt banks were to deal with the 2014 identified risks. Canada ranked first on the preparedness index and also scored lower than the global average on the anxiety index. This could likely be the effect of a number of things. First, strong Canadian banks' profitability compared to their global counterparts. 2, consistent regulatory oversight from the OSFI. 3, a very conservative approach to banking reflected through low loss rates. And finally, perhaps, contingency planning by Canadian banks to deal with the stresses to the economic environment. So it's really great to see that Canada feels much more prepared and less anxious about these risks compared with the prior year and compared to the rest of the world. So I hope that that gives you some insights into what is top of mind for the industry as it relates to risks that they're facing today. And with that, I'd like to pass it over to our next speaker, Marco Fillion.
Thank you very much, Rani. So now we're entering the part of the session where we're going to talk about IFRS 4, some of the developments. The intent here is really not to get into any details, but our goal is that at the end of our few slides here, you have a good understanding of what the key developments and issues being discussed are, and also where is the ISV heading with the insurance contract project. So if we look at the timeline, a very quick recap on that. 2010 was when the ISV issued their first exposure draft, and they followed up on that in the summer of last year with a limited exposure draft that addressed 5 issues. There was the adjusting of the contractual service margin, which is what we call the unlocking of the contractual service margin. The contracts with links to return on underlying items, and this is contracts where the cash flows of the insurance contract are directly linked to the return of the assets supporting them. Use of the other comprehensive income for changes in discount rate related to the liabilities. The 4th item was presentation and statement of comprehensive income. The big issue for the industry being premium presentation mostly, and transition. So at this point, after that, after the June release, there was a period of consultation to the industry that was ending in October. In real term, though, the ISV took comments way after that deadline, and they started reconvening again in January. January was purely just an education session for them. But then in April and May, this is when they started making decisions. This is what we're going to get through in the next few slides. So if we move to start talking about now about the latest development. Before I get into what the ISV has been discussing or not, there's 2 key developments that are quite important. First, with regard to the U.S., the FASB has decided that they will not move forward with IFRS accounting. They will keep U.S. GAAP. Having said that, they also decided that for long-term contracts, they would make some targeted changes to the U.S. GAAP accounting. Some of those examples, I won't go through the whole list actually for that and short-term contracts in a second. If you need any of the details, feel free to contact me. I will give you the whole list. But for long-term contracts, some example, for instance, is to unlock the assumptions on FAS 60 accounting. Other examples would be as well the clarification of acquisition costs, a bunch of other things as well. There's about 5 or 6 elements they want to touch on. And as far as the short-term contracts are concerned, there will be no change to the accounting. However, there will be more disclosure requirements, and the disclosures to be, of course, more in line with IFRS. And there's a list of around 9 to 10 items. A lot of them touching on claims liabilities, disclosures, to the extent that for short-term contracts you're using discounting, the impact of the discounting, transition, interim disclosures, a bunch of things. Again, I'm be happy to send you that information if you want to contact me. The second development was with regard to IFRS 9. It's a different project than IFRS 4, the insurance contract. And what has been decided there is that the effective date of IFRS 9 would be in 2018, January 1st, 2018. And that's very important because this is the current target of effective date for IFRS 4 as well. And having a later implementation or effective date of IFRS 9 prevents companies now to get into potentially 2 waves of asset classification. And so when you look at those 2 together, those are two very big impetus for the ISV to move forward, to really push hard to get their IFRS 4 finished, completed for next year, so that in 2018 it can be implemented. Well, now let's look at what the ISV has decided or looked into since February and March. First of all, the other comprehensive income presentation. The exposure draft said that this was going to be mandatory. They've reviewed that position, and now it's going to be optional. How this optionality will be implemented, they haven't got into the details yet, so this is to be followed. But this was something quite important for a few insurers, or many insurers, I should say, where the balance of their asset classification was requiring a fair value accounting. For instance, they had a big proportion of their portfolio supporting liabilities, potentially on real estate, equities, and derivatives. Having a mandatory OCI would have resulted in a lot of fluctuation or volatility in income statements. So that is addressing that. Good news. On the contractual service margin, they reconfirmed that the CSM would be unlocked for changes in future cash flows. But they've made a couple of, actually one change. They've also now decided that changes in future, or the impact on the risk margin of changes in future cash flows will also be flowing through the contractual service margin instead of going to the P&L. And also one clarification around the CSM is that gains related to favorable changes in relating to future coverage that arise after a loss that was recorded in P&L can be recognized immediately in profit or loss instead of going to the CSM. So this was actually a good clarification that made a lot of sense. Moving on to the next slide, with regard to insurance contract revenue, this is bad news for the insurance industry. There was a lot of concern mostly with the fact that premiums would not make it on the income statement as a representation of revenue. And so the ISV has come back to confirm that revenue is required to be presented in a manner that is prescribed, pretty much as what we've seen in the exposure draft. I don't know whether there could be some modification around that. They haven't tested that. But not only they confirmed the exposure draft approach, but they also further clarified by prohibiting the presentation of premium information in the income statement where it's not consistent with the concept of revenue. So that means premium written is not going to be in income statement. Of course, companies can always disclose in notes, but it's not going to be on the face of the income statement. Also, they came back to clarify that it will keep excluding deposit components. With regard to the other issues, because they were, the ISB, although they only had 5 specific items for which they were asking for feedback, they also realized that there was quite a number of items that required a lot of maybe relooking and mostly clarification. So they came up with, they've agreed on actually the targeted topics that they will redeliberate, which we see on the slide here. And the point I will just make here is that mostly what this will be about is clarifying their position as opposed to a change in position. So we're not really expecting a lot of changes there except as opposed to clarification. Moving on to the next slide, the ISV will now meet in June next week and start deliberating a few other points. One of them, well, the 4 of them will be the contracts with underlying items. So this is the contracts where the liability cash flows are tied to the returns of the assets supporting them. And this is definitely, I would say, a messy part of the exposure draft that really needs to be debated quite a bit. A lot of changes need to happen there. So this is going to be probably more than a 1 meeting session for them. The other 3 is the asymmetrical treatment of the gain and loss from the reinsurance contract. So So this is the whole issue of the contractual service margin for reinsurance contract, which can be positive or negative, as opposed to direct contracts, it's only positive. So there's like no mirroring that happens there between reinsurance ceded contracts and direct contracts. They'll talk about that. And then also the level of aggregation will be clarified. So we're talking about portfolio and calculation of CSM predominantly. And the last point is the one we have on this slide, the one I wanted to spend a bit more time because it's definitely more important for the Canadian insurance industry that has a long-term contract which is related to discount rate. The last exposure draft that we had in 2013 was tended to be narrowly interpreted by some insurers in the industry with regard to the very long end of the discount rate curve, where there's no interest rate observable in the market. So if you've got contracts that have cash flows beyond 30 years, 20, 30 years, some of the narrow interpretation was that you would have to use, of the exposure draft, is that you would have to use the longest observable interest rate as being the long-term rate for all future cash flows beyond that observable period. So what the ISV has come back to look into, and it's been proposed by the ISV staff at this point, is that no, this is really not the intent of the exposure draft. We're not going to tell you how to calculate it, but yes, you need to take into account that your longest observable term is a certain level, but your interest rate beyond that doesn't have to be equal to it, and in fact probably shouldn't. But you need to use your judgment, all the information available, and they will keep to the principle without prescribing the methodology, which from my perspective is very good news. Maybe difficult to audit for auditors, but from an industry perspective, it opens up to the possibility of applying what makes most sense for the jurisdictions and the contracts in hand. At this point, let's go to a polling question. The question we have is, what stage of preparation are you at with respect to assessing the impacts on your business and financial reporting? So the range of answers go to, well, I haven't started anything, to, we started doing some modeling, a lot of modeling and gap analysis with full implementation, just to try to determine our financial and operational impact. And of course, if you're not in the insurance industry, it doesn't apply to you. Just you can apply, you can respond not applicable. So as the answers are coming in here, maybe we'll take a question. So there's one here. Should companies be focusing on this new standard, given all the other competing demands on management, such as OSFI governance requirements, ORSA, and the new capital regime? Good question. I don't think there's a one answer fits all here. Definitely will depend, how you want to prioritize your IFRS 4 analysis relative to all those competing demands. For companies that are focusing on short-term contracts, definitely this is, you will not have the same sense of urgency. Overall, IFRS 4 is not as much of a concern on short-term contracts. For long-term contracts, it's a very different game ball. And at that point, I would say that, given all the development that we're seeing with the ISB, the very quick decisions being made, some of the developments I've talked about at the beginning with regard to IFRS 9 and FASB, we're not looking at another 10 years of debates on IFRS 4. Personally, I do believe that the ISB will be coming up with a standard in the first half of next year to really meet the 2018 deadline. So it would definitely be a good time to start focusing on IFRS 4 implication in a very serious way. All right. So if we're looking at the answers coming out, so I guess most companies have started doing work on IFRS 4. Very few have done nothing, so it's good news. I would say maybe a third, if not more, are kind of in agreement with my last statement in terms of looking at IFRS 4 very seriously and putting some thoughts into how is that going to affect your business, which actually is a good segue into our next slide, talking about next steps a little bit. So as I said, I think IFRS, and that's my personal view, I think IFRS 4 is coming sooner now than later. What happens in Canada, we'll all see as well, because there could be other political pressure around that. But to the extent that the ISB is moving, you may want to start now taking a good hard look at the impact of IFRS 4. Certainly you want to monitor the developments, be close to this, how quickly it'll be moved, educate your key stakeholders within your company, and start doing some impact analysis and lay ground for a very detailed project plan to be ready to get going. So that's pretty much it, Turna.
Great, thanks, Mark. We've got a couple of minutes, and I think we'd like to take some questions now. So if we could start, Barb, I think you've got a couple of questions that have come in to you. I'll turn it over to you.
Okay. So we had a question about whether we're going to be publishing the formula for money-weighted rate of return, we being PwC. The answer is no. And also the CSA has actually said that they're not going to be publishing a formula because people may want to calculate it differently. But I just want to touch on one other point in terms of the fees that's come in, which was around originally, I think the regulators had said they might do a time-weighted rate of return, but then ended up landing on money-weighted rate of return. And that they have clarified that you can provide both. So if you think it's going to be confusing your investors because they've always had the time-weighted return, you can put both in their statements, and then what you would do is you would describe in those statements the differences between the two calculations, and hopefully that'll help investors understand a little bit better what the difference is. I'll hand over to Petrina for a couple of questions now.
Yeah, so we've had one say, how do we ensure that the sales force knows how the trailer fees are calculated if each fund calculates it differently? As we mentioned, that is certainly is a challenge. At least how we've been working with our clients in laying this out is working with the suppliers to lay out, the calculations across the numerous suppliers, look at the similarities and differences, and work together on a FAQ, as well as developing what we've been calling a Tier 2 level support. So having a mix of both online and live support for the front office staff. And then in terms of your implementation planning, it's communication, but again, involving the suppliers up early. And if there's any work that can be done around aligning calculations, certainly it'd be good to get that in process now. We also have another question coming in that's saying, based on what we've seen going on in Australia and the UK around regulation on commissions and fees, do we see more extreme regulation coming in on fee reform? That's a loaded question. I mean, separate from CRM2, a discussion paper was issued by the CSA, which we may all be aware of, regarding how advisors are paid, and also looked at a number of options that could be viewed as more severe or extreme than what we see now. And then a number of institutions have submitted formal responses on concerns to this, consequences, implications. The overall concern is similar to what we heard in the UK. This would in fact limit access to advice and versus making it more transparent, would also mean less choice for investors, which is counter to being, to be objective, and then also increase costs. But at this stage, we have not seen any further progress beyond the initial paper, and we do not have any guidance on how this will progress.
Great, thanks. I think there's a question, Marco, that I'd like you to take.
Yeah, so someone here is asking, now that FASB has pulled out of IFRS, do we see that Canada is going to also do the same thing? And it's actually a very difficult question to answer. There's many variables and components to be able to really have a good grip on that. I'm not the foremost expert on all of the regulatory and legal procedures around that, but I'll suggest to you a few things to think about. Well, the first thing is the fact that the U.S. and Canada would not be both on the same basis is not any change from what it is today. We have Canadian GAAP, they have US GAAP, so we're already in a situation of two different accounting bases. Second is that from an industry perspective, yes, it's certainly disappointing and less relevant if the U.S. will not be also in IFRS, which is the whole point of having an international standard. But also there's some practical issues here in terms of saying, well, Canada, let's not adopt IFRS 4. One of them is that for SEC registrants, that could be an issue or not depending on where you're at today. For instance, insurance company registered with the SEC today are already doing US GAAP accounting and reporting on that basis. So if we would, let's say, not adopt IFRS and say we would want to adopt US GAAP, then they would be fine. On the other hand, the financial institutions, the banks that have insurance companies, are not required to report US GAAP from an SEC perspective for those insurance entities as well, because they are all they're doing effectively IFRS reporting, which the SEC accepts, and so going on a US GAAP basis then would be a significant issue for the banks and their insurance entities because they're not reporting that today. So even within the current industry environment, that's a potential issue. So there's many things to consider. And plus also the whole practicality of getting out of one IFRS when Canada has adopted IFRS as a whole. Remember that IFRS is not an industry accounting approach, is really overall that Canada has adopted IFRS, and so making a specific decision on one industry also has a bunch of ramifications as well. So I don't think I can really answer your question, but if we can consider all of those things, it's not necessarily an easy decision or slam dunk to say we'll just follow suit.
We've had one other question that could come in. It actually might be of interest to the insurance people on the line as well, and that's around segregated funds and whether they're covered by CRM2. The technical answer is they're not, because seg funds are not regulated by 31103. But having said that, insurance companies may want to consider whether they want to do something similar for their clients, just in terms of best practice, in terms of communication with your investors.
Okay, great. Thanks, everyone. We've come to the end of our time and today's presentation. We'll be sending out a copy of the slides after the webinar. You can also download a PDF of the slides by clicking on the green Resolve List icon at the bottom of the console, so you can certainly get the slides from there. We're going to be taking a hiatus over the summer, so I hope everyone has a wonderful summer, has time with family and friends, but we look forward to connecting with all of you again at our next session in October 2014. Thank you so much.